Welcome to episode 79 of Accessible Finance. I'm Eric Johns.
And I'm Rachael Johns.
Let's dive in.
All right, Eric, today we are going to be answering a question that we actually got somebody to write in that said, I got a new job offer, but how can I tell if it's better than what I have now? What things should I be looking at? What questions should I be asking?
Yeah, that's a great question.
All right. So oftentimes, and we've talked to people about this, especially when you're young and starting out, when you see that number that they're offering you on the paycheck, that is the most tempting number that exists.
Correct.
But it's very, very easy to be swayed by that and to forget how to value or that the other things that come that don't necessarily show up in your biweekly paycheck have a value. Right. So what are some of the first things aside from salary, right? Salary is easily quantifiable. What are some things aside from salary that people tend to overlook or devalue?
Benefits, right? So healthcare, health insurance. That's the biggest, I think. Dental and vision sometimes are provided or included, but what percentage they're going to cover for healthcare and then what that entails, right? So what are you actually getting? What's the deductible of the plan? What's the max out of pocket, right? Is it just a high deductible health plan or, is it kind of considered premium health coverage? Because that's significant.
Yeah.
For our family, I think roughly speaking, broad numbers, we're talking like $25,000 to $30,000 a year.
It's a big number.
If we were to try to get, coverage with a reasonably low deductible, call it $1,000 per person, $2,000 max out of pocket per person, which doesn't sound that low to me, but apparently it's low these days.
It is. And thank goodness, because I have been seeing my medical bills lately and those numbers are not small.
They're not great.
No. And I think too, if you're going from, if you're just starting out and you're getting a W-2 job and they're like, and we pay for health insurance. It's really easy to be like, oh, okay, fine. Chances are if you're in your 20s, maybe your 30s, or if you've always had a W-2 job where that's been provided, you have no idea what health insurance actually costs.
It's also very much worth noting that not all coverage is equal, right? We were just talking about what the plans look like. Mm-hmm. Some restrict now to health providers. So there might be an Ochsner specific plan or an LCMC specific plan, right? So that matters. And then as well as the, premiums max out of pockets, what's your copay, there's infinite flavors of health coverage that we're not going to exactly dive into. But the idea is you want to have some idea, some ability to quantify that in terms of convert everything to gross, right? So that what I mean by that is convert everything to gross income and treat it as what would I need to be paid as a contractor, right? Which just means I'm a 1099 employee. I don't actually receive a W-2. I'm not going. My employer is not going to pay my portion of self-employment taxes, or FICA taxes rather. I'm going to have to do it. So if you were going to have to do it, you want to kind of know how much more you would need to make that viable. Because just as a brief aside, employers love to pay 1099 because they get to deduct the expenses all the same. And if I might be paying you, $80 an hour as a W-2 employee, it might be far cheaper with benefits and everything else factored in for me to just hand you $100 an hour and say, you're 1099, deal with everything else yourself, right? I get out of FICA taxes, I get out of health insurance and 401 retirement plan matching, which happens to be the next thing we'll talk about.
But again, I think it's important also to look at, like Eric was saying, the replacement cost, right? So what would you be paying if you're paying your own FICA taxes? What would you be paying if you're paying for the health insurance plan? Now, it's important to note that what the plan that your employer is providing may not necessarily be the plan that you would choose on your own, but it's still worth X amount of dollars, right? Because if you're young and healthy, you might be happier to have a higher deductible or a higher max out of pocket because you're not hitting that.
Correct.
But I think that, even if you're not necessarily looking for your own health insurance plan, going online, shopping around, and seeing how much it's worth is really, really important.
Correct.
Okay, great. And again, like Eric was saying, dental and vision kind of fall under a different umbrella than your typical health insurance policies. They're usually add-ons. If you have a company that covers that, congratulations.
Right. Some companies will do HSA matching, right? So they'll offer high deductible health plans or access to high deductible health plans. And then they'll contribute to your health savings account, which is, a viable strategy if you have significant cash flow and are younger and are not looking to use health insurance. The company can contribute and you can treat it, as a tax-deferred, potentially tax-free savings vehicle.
In that case, though, Eric, like how would somebody try to quantify that, right? Like we
It's
know
difficult.
the offering of a health savings account is amazing, but if you're somebody who's not really in a position to be able to take advantage of it, it's worth nothing to you.
Correct.
But like Eric said, like if you have a pretty high cash flow and you're able to, on top of meeting your other like goals and your financial targets, contribute some to an HSA, that's amazing. And just the offering of the HSA itself, I would think would be worth something in addition to the matching. So
yeah, absolutely.
It will really be dependent in that situation on like your position.
Sure. So one thing that I mentioned earlier, right, or another thing that I mentioned earlier is retirement plans. So many companies don't offer them. Just straight up do not offer retirement plans, which is kind of wild this day and age. But the bigger institutions do. However, they are not all equal, right? So some companies might match around 3 or 4%. Some, will match, 3% if you don't do anything, 2% if you don't do anything. I believe it's Ochsner's 2% if you don't do anything, and then they're 50% of the first 4%, I want to say. So that's essentially, 4% matching, but they're going to give you 2% just regardless. So even if you're not interested in contributing. But the idea though is if I make $100,000, every percent that the company's willing to contribute or to match, I'm gaining 1,000 pre-tax dollars. Does that make sense? So like they're putting that money in my retirement account on a pre-tax basis, right? So like I'm going to have to pay tax on it when I withdraw that money.
Sure.
So I don't want to think of it as after-tax dollars. That's not the same.
Right.
Does that make sense? So like if a company has 1% more matching, but the other company's going to pay me $1,000 net more, I'm happier with that. To just actually receive that
$1,000. Yeah. Because so essentially, like if they're putting, 2% and you're making $100,000. So if they're putting $2,000 into a retirement account for you, part of that $2,000 before it's grown, before it's done anything, is earmarked for the government. So like it's probably a good rule of thumb to imagine that it's worth what, 70%?
No, it's gonna be more than that.
80%?
I think it's more than that. The idea though is that there's some flexibility there. Like if they were to pay you $1,000 more, you have to pay the FICA taxes up front, but then you can defer it. So I guess you're getting the money net of FICA taxes is kind of my point. Does that make sense? Or net of their half of the FICA taxes. I'm getting a little in the weeds here.
Very
also,
in the weeds.
Sorry, the one thing that I wanted to point out though is
we're looking for napkin
FICA taxes.
Here.
Right. So FICA taxes, for those of you that, are uninitiated, I guess, or just don't really care that much about
if you're
this stuff.
a W-2 employee though, you'll be able to see it on your...
Correct. FICA taxes are just referring to the Social Security and Medicare portions of your taxation, right? That's going to be withheld from your paychecks. That it goes straight to the government.
You've probably seen your paycheck and then seen the amount that goes into your bank account and said, "What the heck happened to the money I was supposed to get?"
So there will be federal withholding, state withholding, Social Security withholding, and Medicare withholding. So FICA just refers to the Social Security and Medicare withholding combined. Right. So the idea is we want to try to quantify as much as we can the benefits of being a W-2 employee and that specific employers are going to offer you for working for them. Right. So there's more to compensation than just the number that, your friends might ask you how much you make.
Like ultimately, we want you to be able to do some type of napkin math to be able to quickly say like, okay, so I have my salary, which is worth X amount, but then you have these other things that are a bit harder to quantify. And the goal is to be able to quantify them, to add to said salary, to say, okay, my total compensation package is X.
Right.
And it helps feel like you're comparing apples to apples when you're comparing different job offers. So the retirement plan is a big one. Again, not every retirement plan is created equally. How might somebody go about valuing a retirement plan? Like, let's say that you have, job A doesn't have a retirement plan.
Right.
Job B does have a retirement plan.
Well, that's already a huge deal, right?
Correct. But then
But now you need to quantify it because job A is going to pay you more. Yeah. Yeah, that's a great question. So you can look at the either matching or employer contribution. So employer contribution is referring to the employer putting money into your retirement plan, whether or not you defer a single penny of your salary.
Like you just said with Ochsner doing like the 2%.
Yeah, they do 2% flat, I believe. Then the matching refers to how much of the employee deferral percentage will the employer match. So it's convoluted, but just an example will illustrate it. Some will say, like, let's use Ochsner again. So Ochsner has an employer contribution of 2%. That means if I make $100,000, Ochsner's going to put $2,000 into my retirement plan, whether or not I defer a dime, or whether or not that my deferral into the retirement plan is anything, right?
Yeah.
Whether or not it exists. Then they'll match 50% of the first 4% of my deferrals.
So another 2%.
Correct. So if I now contribute $4,000, because it's 4% of my gross, right? 4% of my $100,000, we're going to say it's $4,000. So I'm going to defer $4,000 into the plan, and then they're going to match 50% of my 4%, which is going to be, 2%, or in this case, $2,000. So they're going to give me half of that. However, if I go and match $10,000, or if I go and defer 10%, I'm allowed to do that up into the cap of $23,500 if I'm under, 50.
They're still just doing the.
They're still going to give me $2,000. Right. So that's why you see like 50% of the first 4%, because they only care that they're going to cap it. They're not going to give you 50% of everything you contribute.
Okay. So correct me if I'm wrong here. I know for us, when we are talking to clients, prospects, friends, whomever, we will tell them till we're blue in the face, contribute up to the matching. Always contribute up to the matching. It is free money. Always contribute up to the matching.
Correct.
So in this case, right, I would imagine that we would advise somebody to value that retirement plan at $4,000 or whatever percent of their salary, right?
Yeah.
So you should value it at the entire matching because you should be doing the matching.
I think that's reasonable to do.
And even if you're not doing the matching the very first year, right? The idea is that it's money that's still available, whether you're choosing to take it or not. It's part of your compensation package. So you should be quantifying it up to the full match.
Right. Exactly.
Okay. Perfect. What else is on the horizon?
The investment options and fees in the 401k plans do matter kind of a lot, actually, particularly if you're going to stay there for a while.
We've seen huge variance.
Absolutely. So some are virtually free.
Yeah.
Right? They might be $50 a year or something. I believe Ochsner's is actually relatively nominal. I think it's something like that, like $20 a year or something very low.
That's amazing.
And then the expense ratios on many of the funds, some plans will give you access to Vanguard funds, right, which are typically going to be lower cost.
I would say the majority of people, and what they tend to advise you when they come in and do benefits presentations and stuff, is the target retirement date funds.
Correct. To be clear, that's not a terrible option if you have no idea what you're doing.
Yeah.
Right? Like they're made for average risk tolerances, not the worst thing in the world. I just wanted to say that briefly. We don't have to go into target date funds and their viability.
No. And I think honestly, like when we're talking napkin math,
do a lot worse.
These are things that may be too granular for a typical person who's going through and doing napkin math. But if you have a close friend or a partner or somebody else who has their like 401k options available that you can look at and compare, it can help you to know what is available or how to, compare yours accordingly.
Yeah.
We're in the fortunate position where we're able to see a variety of retirement plans. So it's a lot easier for us to know whether one is high or not. But typically you're kind of functioning in a vacuum.
Right, there's two things you're wanting to look at, right? Yeah. So you can find this information usually in what's called the summary plan description.
Which is a really tiny document. It's very easy to read.
It's usually not very difficult. It's usually not very easy to find. Even for, we'll go to clients' houses and they'll log in and say, hey, find it for me. I don't know where to click. And it still can take some time.
And say again what it is called.
Summary plan description. Yeah. Right. So they're supposed to tell you what expenses and fees are going to be associated with the plan each year, but even sometimes in the SPD,
it's still hard to find.
Yeah, well, they'll also use generic language, like this plan is subject to the fees of the custodian and yada yada, and it won't actually give you like it's 1.25% a year. Right. There will be at some of these documents somewhere a breakdown of the fees, but sometimes it's very difficult to find that. But the point is, you're trying to find two things, right? The first is you're looking at the individual investment options and seeing how viable they are. What are the expense ratios like? How are they managed? Are they actively managed? Are they passive? Are they tracking indices? Are they comfortable with an investment strategy that you want? Do they offer target date funds if you're kind of, a bit unsure where you should be and you just want to have average, risk tolerance, whatever, and you want to just put in a target date fund? Do they offer that? And what do the expense ratios look like? So what are their offerings and how expensive are they? And then the second point would be, what are they charging you just for the benefit of holding your money inside of their plan? So they get to charge that. Sometimes advisors will be on plans, right? So like I'm a financial planner, financial advisor. I couldn't go and sign up to be a plan fiduciary and give people advice on their investments and everything else. But then I would charge them a fee, right? Like so there's that. You want to look for what the fee that the plan is paying. So there can be, the companies that are holding the plan might charge a fee. The advisor on the plan could charge a fee. So you want to kind of net all of that out, add everything up, and find out what the fee is that they're charging you every year just for having your plan there. Because if you have a large balance, or as you accrue money in your 401k, it's not unheard of for you to get, $500,000 in there.
Yeah.
Well, 1% of that's $5,000 a year that's just coming off the top as fees before even the expense ratios or anything else.
That's a really good point.
Because sometimes it goes up to 2, north of 2, sometimes 3.
I mean, by the time that people are, 5 years out from retirement and they're looking seriously at working with a financial advisor or somebody like that, their largest
assets are typically the tax-deferred 401k.
Yeah, the 401k balances are the largest assets. And so you're taking large percentages that don't really change, right? So we're not looking at, it's not like the more that you make, the smaller amount you take.
Right.
It's still.
No, not at all.
Yeah.
So and that's going to come off the total account. And then expense ratios function the same way.
With the individual investments.
So yeah, right. So there's one charge for just the whole plan usually. And sometimes it's nominal. Sometimes it could be, $25, $50 a year. Or sometimes most of the time it's percentage based, so 1%, 2%, 3%. And oftentimes, we'll have somebody inquire about our fees and we might say, oh, okay, it costs, 80, 90 basis points to work with us, or 1%, let's say, to work with us.
Yeah.
And they're like, oh, that's so expensive. And you look at their 401k and they're paying like 2.5%. And you're like, well, what are they doing for you, right?
Yeah.
Like, how many times have you met with your 401k advisor? And they're like, I have a 401k advisor? So that's
so true.
Unusual.
Usually you're just meeting with them during the benefits presentation.
Yes, it's hard to find. Yes, it's convoluted. But if you're able to check the expense ratios and the plan fees that are associated with your workplace retirement plans, it's to your advantage to do so.
It's one of the first things we do with somebody that's coming over and working with us.
Absolutely.
And so then some of the other areas that we would look at that people, should try to quantify, but that may be even less difficult to quantify are going to be things like paid time off.
More difficult.
For that one, at least you can quantify like how much money you make per day.
Sure.
And you could count it that way if you wanted. You also need to look at whether or not those days are like use it or lose it, or whether they roll over. Things like work flexibility in the wake of COVID, there's been a move
work
to
from home matters.
Remote stuff. Exactly. And so if that is something that you value highly, right, that's something you would have to kind of internally assess, like, what is that worth to me?
Yeah.
And whether or not that's an option, how flexible they are. If you've got kids, Lord knows flexibility is of the utmost importance.
Right.
Also then commute time, right? Like how far away is the job actually from you? What is the cost in the commute? Do you have to pay tolls, what have you, parking? And then career growth opportunities is another area as well. Are you looking at, staying with this company for a while? Have they, do they tend to promote from within? Do you have kind of a clear picture of where you want to go? Or are you kind of stagnant there for some time? So those are some other areas.
Absolutely.
To look at there. So then again, like we said, you want to try to quantify all of the things, some more easily than others, and kind of sum those up together. But even still, while doing this, it can still be incredibly tempting to follow the larger price tag, the larger number on the paycheck. Because it's big, it makes you feel successful, like you've made it.
Might represent more money today.
Yes. So the deferred gratification is like definitely a challenging thing. It will set you up certainly for your future, but you may not, especially if you're right out of college, you might just be like, I worked really hard for this, like I'm ready. Now, there are sometimes some red flags that people may overlook as a result of a very large paycheck number or a number bigger than you may have expected. Eric, do you have any top of mind that come?
Yeah. Not having any retirement plan, that's typically not great. I would also add that if they're trying to pay you as a contractor, very important. Yes, owning your own business, you can take some deductions. That's almost never going to outweigh the additional costs in terms of self-employment tax, and then really the headache sometimes of running your own business and all of the things that are going to fall in your lap now that your employer would otherwise be responsible for, including, being responsible for your own retirement plan and health insurance. But anyway, so retirement plan, vesting periods, we haven't talked about that, but vesting is essentially a way that retirement plans can limit access to money. It's a retention tool for employers. So they can have, cliff vesting or graded vesting. Cliff means you have access to 0% of it. It's all the employers if you separate from service before the time period.
Yes. It doesn't just apply to that. It also applies to like earning PTO and bonuses and all that stuff.
Yeah, there's all kinds of deferred comp payout structures with vesting schedules.
Right.
So, but typically there will be like, a 2 to 6 year graded or like 3 to 5 year cliff. What that means is I will be entitled to none of the retirement plans. Like it'll still work the way that we talked about. Maybe they're like, maybe they'll match 6%, the first 100% of the first 6%.
Yeah.
So their plan is great, but they will give me access to none of it if I leave the company before 5 years.
Yeah.
Right. Or they'll do a graded schedule, which means I'll get access to like 20% after year 1 and 40% after year 2 and so on. Right. So they'll give you access to a little bit more over time to incentivize longevity with the firm.
Yeah. Now,
which makes sense from their perspective.
For sure. But if the vesting period is abnormally long, that could suggest some high turnover problems at the company, right?
Or, if you just want to use the company as a stepping stone, you need this client services role so that you can go and open your own RIA or something. Well, you
might be willing to sign on for that.
You might still be okay with it, but you need to know, like, hey, look, I should just not count on any of this money because I know I'm leaving in like 2 or 3 years.
Correct. Exactly. And then also, if you're in the middle of, if you've gotten the interview, they're now going through to the offer stage and they're being cagey about, there's this commercial, I don't know if you've seen it. There's this commercial, I think it's for Indeed. This guy's and I've seen it a million times this summer with the kids, but this guy's sitting across the table from this woman and he's like, how's the salary? And she's like, competitive. And he's like, what kind of competitive? Like competitive or competitive? She's like, between competitive and competitive. And then like his phone goes off and Indeed gives him a salary. If you're having to pull teeth to get information during like it may be a bit more during the interview, but like if you're in the offer stage and they're not being fully transparent about your bonuses, the package, the entire package and benefits, I would be nervous about that.
Yeah. It's actually kind of frustrating when employers don't list the compensation in the job description.
Yeah.
That's kind of frustrating.
Yeah.
But, that's
it is what it is.
They're trying to be,
Yeah. But before signing on, you should know the entire compensation package for sure.
It's important to understand the benefits.
Yes.
They are part of the compensation package. It's not relevant for them to just give you a gross number. You'll be making $80,000 and you have no way to quantify if that's good or bad relative to the other offer that said you'd be making 90.
Well, exactly. And how frustrating to get to a job. You've now let, the other job offer go away. And then you realize that what you expected or what you thought is not what it is, right? So this is why, bottom line, there are some major takeaways essentially from here. Number one, right, would be to always evaluate the entire compensation package, not just the salary, by, essentially going through the steps that we did and creating a large addition problem. Quantify all the things. The benefits, the retirement, the flexibility, again, assess what things are most important to you in a job. I will say that after having kids, flexibility in the job became a lot more important to me than it was prior to having kids.
Sure.
So your values may change as well.
I think vacation days are a big one that people overlook until they reach a point in their career where their earnings are increasing.
And they're ready.
And they're no longer limited by the ability to earn the funds or have the dollars, the access to the dollars, right? Like in your early career, in your 20s, right out of college, you typically don't have an extra, 10, 20 grand a year lying around for an extra Disney trip or ski trip or whatever it's going to be.
Yeah.
Ski trip.
Universal.
No.
You're going.
Yeah, snowboarding. So, you won't have the money lying around, but at the point in time you do, it's going to be a lot more relevant, how many days you actually get to spend with your family on these kinds of vacations, right? So you might want to take 3 or 4 vacations a year. You might have the funds to do it, but your schedule's limiting and your workload is too demanding for you to actually enjoy your experiences. Then that's a factor that might matter, especially when you get to, higher earning levels. Like if we're talking like, okay, this job is like 150K or 200K
Yeah.
even, but it offers, 10 vacation days a year versus now I have an offer that's, maybe 100, 120, but it's giving me 30 vacation days or something.
Right.
Maybe my spouse is a high earner as well.
Correct.
Has
And in
access to
addition
vacation.
to that, it's also important to look into what their like maternity leave
That
options
matters.
are as well.
Absolutely.
Super huge. The United States is not known for being super great about this.
Nope, usually pretty terrible.
Yes, but different companies have vastly different.
For sure. Absolutely.
Oh my goodness.
Yes, we have absolutely seen that.
It matters a lot. So if it's something that, again, when you're fresh out of college, right, you're in your 20s, you may not necessarily be thinking down the line about having kids. But if that's something that even plays into your thought process, it's certainly worth asking about and knowing about. And then, there are even fewer companies that offer anything, close to a paternity leave. But again, certainly worth asking. Like you stayed with me for a week, right? So he had 2 weeks and it was at a certain time and he negotiated being able to move one of the weeks to after the kids were born. And I will tell you, oh my God, I couldn't have done it. So it was very, very much appreciated.
Absolutely.
So again, in the vein of like vacation time and stuff like that, at least ask about maternity or paternity leave.
100%. Just don't stop at the gross figure. Do not stop at the number for the salary. Look beyond the number and try to think through, medium-term satisfaction, flexibility.
Yeah.
Try to gross it all up.
Exactly.
And see what you're actually getting.
Correct. And then again, if you have any write-ins or questions about any of this, please don't hesitate to shoot us an email at podcast@equilibriumfp.com.
All righty. Thanks, guys.
Till next time.
Thanks.